Hey, welcome to Everyday Economics, the podcast helps you learn about the economic world happening around you every day. I'm your host, Chris Krug, CEO of the 501c3 nonprofit Franklin News Foundation. Everyday Economics, a production of America's Talking Network. You can check out all of our terrific podcasts at americastalking.com. To support podcasts such as Everyday Economics, please make a tax-deductible charitable contribution by clicking the link in the show description. We are recording this episode on Friday, September 6th. And joining me, as always, my friend and colleague, Dr. Orphe Divounguy, PhD economist. Dr. O, some new data became available today. The jobs report is out. Looks as if we've added 144,000 jobs. That's what the Department of Labor is telling us. That number came in a little bit light, as did the number last month when we brought in 114,000 jobs. Let's talk about your take, or let's get your take, I should say, and we'll go from there.
Yeah, it's all about population dynamics. The labor market seems stuck. And let's go through the numbers really quickly to make sense of what I'm about to say. Employment growth slowed more than expected in August. Employment increased by 142,000 jobs. And remember, that's also after downward revisions in July and June, right? So basically, we added fewer jobs in June and July than we previously thought. But this is a rebound from last month's increase. And the unemployment rate fell slightly from 4.3% last month down to slightly above 4.2% this month. So why would we have, right, an increase in employment and an unemployment rate that falls slightly, right? That's pretty much flat, essentially. And then when you look at all the other surveys to just kind of make sense of the jobs report, you look at the JOLTS report from last month, from the month before. You look at the not the establishment survey, but the household survey as well in this jobs report. What do you learn? You learn that hiring separation rates are flat, but the size of the labor force is hitting a wall. You basically, you can't create jobs unless you have people that are coming into the labor force to fill up whatever vacancies are available, right? So businesses are kind of like, okay, we have this number of vacancies has come down a little bit, but we're keeping the hiring rates pretty much flat. We're not increasing our hiring rate, but we're not getting rid of people either, right? And so if you have a flat hiring rate, but you have more people in the labor force, right? Basically, employment will be created, net jobs will be added. And that's exactly what we're seeing. If you get a boost in the labor force, you get a bigger employment increase. And so right now, we're not seeing that. The labor force is basically stalling. Another data point to kind of make my point here is wage growth actually ticked up, increasing 0.4% on a month, higher than the 0.2% in July. And wage growth on a year-over-year basis came in at 3.8%, which is higher than the 3.6% that we saw in July as well, on a year-over-year basis. And so basically, if you have vacancies, if you have jobs, but you still barely have enough workers to fill those jobs, what you end up with is upward pressure on wages, which is exactly what happened in the month of August. And so we're in a point where the labor market is somewhat balanced, but still like hitting. Basically, the balance is fragile because you still have slightly more job openings than you have workers. And so in that situation, you're basically at a point where, I would call this a full employment labor market.
Okay.
It's a full employment labor market. It's a labor market that is not moving anywhere, essentially. It's not moving in the up and it's not moving down either.
Right.
And so, but it's teetering on the brink, right? If the Fed doesn't accommodate, right, then potentially it could stay stuck, and a small shock to the U.S. economy could actually send it into contraction territory.
Well, let's
And
talk.
I think that's the concern, right? Is
Let's
that
talk.
basically, yeah,
So, I was looking at the Wall Street Journal this morning, and, the story immediately under the jobs number, which you articulated, I think you got it right. I think I said 144. I think it came in at 142.
right.
But the Wall Street Journal story said that a poll of analysts, I guess taken within the last couple of days, that 51% of people who are analyzing, the Fed funding rate are betting on a 0.5%, half a percent drop in the rate. 49%, I think, went the other way, which was 0.25%, and I don't think that there was much of a measurement for people who said that it would stay the same, and certainly nobody's going the other way with this. So what's your take on the much anticipated Fed funding rate change?
Yeah, I look at the Fed funds 30-day Fed funds futures prices, and ultimately, I think most investors expect the Fed funds rate to fall by 25 basis points at the next meeting.
Okay.
And the probabilities, you're looking at about 61%, 25 basis points, 39%, right? Expecting a 50 basis points rate cut.
Okay.
I think people are going to look at today's jobs report and they're going to think, oh my goodness, the labor market's slowing really fast. And perhaps the Fed needs to cut by 50 basis points to play catch up. And I think that would actually be wrong. I don't think the labor market has cracked. And I think it's going to take a shock for the labor market to crack. Employment growth is slowing because the labor force is hitting a wall. And what that tells me? That tells me we need more workers. We need more workers. Yes, the Fed might need to cut a little bit to make it easier for businesses to actually fund their operations, hire more workers. That will help, of course, boost employment. But what is boosting employment if you don't have enough workers to go and fill those jobs?
Right.
I don't think that's what they want to do. And so they're probably going to just, we're at a place where the U.S. economy is somewhat stuck in place, essentially. And yes, the Fed does not want to stimulate this economy to the point where it causes inflation to come back roaring, right? Yes, inflation's pretty much the battle's pretty much done, but it would be very easy to get back to where we were. And so right now, I think they're going to be very happy to keep things evolving the way they are evolving. The Fed chair said they do not welcome further deterioration of the labor market. So they might want to give themselves a little space and hope to see employment growth rebound to maybe 175,000 to 200,000 jobs a month. So they're going to cut a little bit and see what happens next month in the next month jobs report. But I think that's going to be it. It's going to be a gradual decline in rates, not a big decline, a large decline like we've seen in the past rate cutting cycles.
Okay.
And I think that still stands. I don't expect the Fed funds rate to fall like an elevator, as it has when basically the Fed was completely behind the curve, cutting rates because the U.S. was already in a recession. Remember, it takes a shock.
Yeah.
And it's a shock because no one sees it coming, right? So we'll see.
Well, I appreciate your thoughts as always, Dr. Orphe. Divounguy, this has been Chris Krug. Subscribe to Everyday Economics at americastalking.com.